Welcome to our introductory video tutorial on cash flow statements. This video is meticulously designed for non-finance managers, business owners, entrepreneurs, and anyone who aspires to master the understanding of one of the most pivotal financial statements, the cash flow statement. So, what is a cash flow statement? Often referred to as a statement of cash flows, it's a financial document that provides an in-depth overview of a company's cash inflows and outflows during a specific period. It tells the story of how a company's operations influence its cash position, where its money originates from, and how that money is allocated. The cash flow statement is divided into three sections: operating activities, investing activities, and financing activities. Each section tells a unique part of your company's financial story and is a crucial component of complete financial analysis. Operating activities. What does this mean for your business? This section deals with cash generated from your business's primary operations. We'll explain how this cash generation is calculated, starting with net income and then adding or subtracting items based on changes in the operating accounts on the balance sheet. This includes accounts receivable, inventory, accounts payable, and accrued expenses. We'll also delve into underlying elements like depreciation, changes in working capital, and their substantial impact on the cash flow of a company. Investing activities. How do these investments affect your cash flow? Here, we'll explore the influence of long-term investments, such as property, plant, equipment, and other assets on your company's cash flow. This section records cash spent on long-term assets, cash outflows, and cash received from selling long-term assets, cash inflows. Understanding this section can give you insights into how much the company is spending on maintaining and growing its operations. Financing activities. How do these financial decisions impact your overall cash flow? This section concentrates on how cash exchanges between a company and its investors or creditors can affect the overall cash flow. It covers activities like issuing shares or bonds, paying dividends, and repaying debt. By understanding this section, you can see how a company raises capital and pays it back to investors via dividends or share buybacks. So, why is a cash flow statement useful? Understanding the cash flow statement is essential as it provides information about a company's liquidity and solvency and the ability to change cash flows in future circumstances. Moreover, it provides valuable information for evaluating a company's investment, financing, and operating decisions. A cash flow statement is a key to understanding the health of your business. It helps measure the effectiveness of business management. It provides insight into a company's short-term viability, its ability to pay bills, and fund operational growth. It also gives investors a clear picture of how a company is generating cash and how well that cash is being used. So whether you're steering a startup, managing a small business, or leading a department in a large corporation, this video is your ultimate resource for understanding cash flow statements. Don't forget to hit the like button if you find this video helpful. Share it with others who might benefit from it. And subscribe to our channel for more easy-to-understand finance tutorials. Together, let's take a deep dive into the world of finance and unravel the mysteries of cash flow statements. We wish you a fantastic day ahead and a prosperous financial future. Here's to your success in mastering finance and accounting, one concept at a time.